Alright, so welcome everyone, this is JAVIII.fx and welcome to a price action video, right? So with price action, let me just say this. Price action is heavily dependent on the candlestick, the price rejections and the volatility of the market. What are you seeing? What is the candlestick formation, the patterns showing you, right? So may say the candlesticks are the language of the chart. So may say, it is what you can use to determine price. But I'm going to talk about the candlesticks in the beginning, but I don't want it to be your main source of direction. I don't use candlestick as a bias, because while it could be said it is the language of the chart, think about this. The candlesticks are just a representation of price. That's not what moves price. So even if the candlestick closes a particular thing, that doesn't necessarily mean that the candle will go there, right? Seeing a bearish doji doesn't mean that the market will sell. It could be a trick of the market. Now, with all that said, you already read the candlestick Bible. I hope you read it. You've gotten it in your email or seen it down below. You read the candlestick Bible. So I'm not going to go or dive too deep into the different candlestick patterns and formation, but I have a few key ones that I'm pointing out to you that you guys should focus on, right? So check this out now. You will see morning star, you will see evening star on the whiteboard, right? These are one of the well-known candlestick formation, right? And there are oftentimes the market makes things like these, right, to follow. You have the doji, both bullish and bearish, right? And sometimes you will see, pretty much nobody at all just align. Right, as long as it has long wicks, it's a doji and it have a small body. You'll have marbles that can do bullish marbles and you have bearish marbles. These are the ones that I want you guys to focus mainly on. You have tweezer top, you have hammer, hangman, etc. You don't need to focus on all of them. But one thing I would like to say though, even if you don't want to understand every single one or know all of them, you can even use the candlestick indicator on TradingView to actually help you. You will identify all the candlesticks that are there on the chart. You can even edit it, edit the settings for it to identify the ones that you want to see. Like you would say, I want to see marbles, doji and morning star, right? It only show you those. It won't show you tweezer top, evening star, etc. Right? You can do that. So yes, looking at the candlestick patterns, you can use this is part of price action, right? You can use this to help with the market structure to get a bias and also to get an entry, so it's still important, right? And of course, we as traders, and in this course we focus mainly on the candlesticks. Now you can use a line chart, you can use bar graph or bar chart, you can use Icanashi, you can use etc, but we're going to use candlesticks. Now price rejection is something that is very important, which is the main part or the core of this class that we're going to discuss. But before we get into that, let's look at the volatility, right? Volatility is just, of course, you can check the definition in the course document. Volatility is the fast movement of price, how quick the price move from one point to another. We use that in price action to determine where the market is making that. When the market is making an impulse in a particular direction, then you say, all right, its impulse is to the uptrend or to the upside. You say, all right, this is an uptrend. We have impulse downwards. It's a downtrend. You can find impulses. You can find, identify such things. You can identify a lot of things, especially with the news and so on. But as I said, it's in the document. Check out the document. You get more information on volatility, right? I just put it right here because it is part of price action and it is important part of price action. These three help you with your chart markups, your analysis when you're doing your analysis along with market structure. Price rejections now, which is, as I said, is the core part of this class, is where you will see rejections of key levels, right? You need to understand what the rejections mean. Now, there are things behind the scenes that you can reason out. Now, you have to use logic. Whenever you're analyzing the market, you need to sit down and use logical thinking, right? Check this out. When you're at a support and you see the market making weak rejections like these, you say, all right, this is a strong level of support, right? If the market you would then try to look at entries for a buyer or something, right? So if the market decides that it should come back to this level and test it again, you anticipate that the market will buy again. Likewise, this trend line, you see where the market makes this great rejection of the trend line, you know, and it's pushing to the upside. You will try to get an entry into this, in this candle going up, or you know, whatever it is, right? You're looking at the weak rejections to the structure that we talk about in the previous class, market structure. With the resistance though, you see these weak rejections, you expect this is a strong level, so you're expecting the market to sell. And with the downtrend line, also this is a, you know, rejecting the trend line, so you're expecting the market to sell. Bear in mind, you should read the document by now, but you guys need to read the document and watch the videos, because it's very important to do both, right? The trend lines, they are dynamic support and resistance. So you find that pretty much everything when it comes down to market structure is either support or resistance to price, right? Either keeping it down or keeping it up. One of them. So you have trend line, you have the uptrend line is a support, and downtrend line is resistance. Seem like you have the support as a horizontal line and resistance as a horizontal line, right? Still support and resistance. No, but everyone is just key structure. Now that we get that out of the way, when it comes down to rejection to the levels now, you need to think about what's happening behind the scenes with the level. Because there are times where, when you're doing the analysis, you will see where you have a level of support like this, and then the market comes down. You're not anticipating that the market is going to respect that level, right? And then go up, continue upwards. But what if the market comes back down and started to make candles that are closing in that level? The candle closed with a smaller wick right here at the support, and there's a candle that closed inside that level. Now before, the market rejected that support, right? It had a huge rejection right here, then it had another huge rejection. Now when the market comes back, now the market has a weaker rejection to that support. So what is this telling you now? That this support is now weakening. It's no longer strong. The retest, right? It weakens. Now, this is what I said before in the market structure video, where you need to think about these things, because sometimes when the market is rejecting strongly, there are traders out there. Some of you guys see that it is rejected and it is strong. They're thinking that, oh, this is a good level, it will buy, and then they end up fail because the market then, well, before it even break, the market comes back up, show them a little buy candle, and then afterwards it just fall, something like this. It's happened to a lot of traders, so I think it is very important to mention this. You need to look at the strength of the level and understanding that when the market is strong, the structure is strong, it can become weak. And how you can spot that the market structure is now weak is when you start seeing that the candles are closing within it, right? Or when the candles starts to have like smaller wicks above that level. So you have to be careful. Now this level was strong before, now it's weak. It is weak. And the opposite happens as well. When the market has weak candles above the level, the strength can build up over time. Now remember, you know, what is happening with the foreign exchange market is you have buyers and you have sellers, right? So when you have this level of support, everybody is seeing this level of support. So you have people trying to buy at this level of support. So when the market comes all the way down here and reaches this level of support, we have a lot of people buy and push the market up, and it was strong before. Now all these people that were buying, or most of them, close their trade all the way up here. Right? So they're out of the trade. So now the buying pressure weakens. You have less buyers in the market, less people to push the demand of that currency or that asset. So if the demand is decreasing, then the opposite, supply, will take over. The sellers will take over. And if they push back the market down here and they don't have enough buyers to come back in the market and push it up again, then it will break. And one way of identifying when the buyers are weak is when they see the market coming back down with strong bear pressure, bear candles, and the market is closing within that level. Right? That's pretty much it with that. You have right here, so now where you see the market breaks this and weeks out now. Likewise in the course document, as long as the market though close below the level, it is still respecting it. So you see, even though the market went all the way down here, people are trying to sell it, trying to sell it. No, wait until the close of the candle, because then the market comes back up. All these people are trying to sell after this, they got wick out. They got stop out. Right, the market just literally want to wick down there. There probably some order block or some level that the market needs to test before it continue up. And you know, I think it's a break of trend now. This is why I don't like the whole break of trend trading. I think, quite frankly, it doesn't make sense. Using the level of structure is what is more important. The level, the support level, regular support, horizontal level and resistance to buy or sell. That is what you should use. Using this to get your initial trade doesn't make sense. Only way you should do this is if you want to get additional position to get it in the direction that you want to. Because a lot of the times the fake outs happen with trends. It happens more times with, well, probably around about the same amount when it fake out of support, regular support and resistance. But with trends, it happens a lot. A lot of people like to draw the trend line and the market fake them out. So you have to be careful. Likewise over here, there's a strong rejection of this. Right? Now, you could say, alright, if the market comes back, you will probably take the market downwards, you know, sell it or whatever. But this time when the market went to this level, the sellers were strong. Now, you would have to wait to see if when the market comes back, if the strength of the sellers will still be there before you can say, alright, this definitely is going to come back down. Right? Not because there are strong wicks, meaning that it will have huge rejection again. It could be something like this again, where the market comes back up and starts to close within the level. Now you know that it is weakening. Or you could see a case where the market comes up, started to, you know, when the market was buying before, it was coming with strong candles, and then when it reaches close to the level, it starts to give like smaller candles like this. You know, this is an indication to show you that, alright, the buyers are slowing down, they are closing their position. Remember, you have big impulse coming up, but when it's close to this level, the buyers are starting smaller candles starting to get smaller. That means the buying pressure is weakening, and the buying pressure is weakening close to resistance. Chances are it's going to reject it like how it's rejecting now, and you start to see some signs. So this is what you guys need to understand. There are a lot of people who don't understand what is happening behind the scenes because they're not reasoning it out with logic. They want to buy when it's high like this and they want to sell when it's low, which doesn't make any sense. Using price action and understanding simple logic, like, you know, big pressure, and then you see the candlestick starting to get smaller and smaller and smaller. That's just simply showing you that the buyers are weakening. Buyers, people that were buying are pulling out of the market, and the sellers are taking over. That is why you see the candles getting smaller, and you will start seeing bulldozers and stuff forming there because the sellers are now competing with the buyers, and their pressure is forcing the buyers to close or forcing the candles to get smaller, and that is what's happening. Now there's something else I want to leave with you, right? There's something else. If you think about volatility of the market and price rejection, think about this, right? You see, sometimes when people see a huge impulse, you know, like when news hit, or just in general, you see a huge impulse market buying on the 5-minute time frame, and, you know, giving a 30 pip, 50 pip, you know, just going up like that, and it's heading toward resistance, right? And people seeing this and they want to buy. You know what you need to think of? Think about this. If the market is going to buy, it will sell sooner or later. Right? What goes up must come down. And if the market is shooting up with such high momentum into a level of resistance, then it will make a huge momentum rejection, or a highly volatile rejection. Right? Think about a ball. You throw a ball on the wall. If you throw a ball on the wall and you know, throw it with a small force like this, then it's just going to bounce off with pretty much equal but opposite direction, right? Throw it on the wall and it comes back around the same force as we throw it on the wall as, roughly, right? But if you decide to hold a ball now and throw it on the wall with huge velocity, right, high velocity, then that ball will come back with a high velocity. We're round about equal amount of force that you put on the ball to hit the wall. So when you put that to the market, the same logic now, if the market is shooting up to a resistance with high velocity or high volatility, then when it hits that level of resistance, a lot of orders resting there, then it will be pushed down with similar amount of momentum, right? So you have to think about that. If the market is moving slowly to a level, then chances are it won't be rejected as great unless there's a lot of volume waiting at that area to push it to the opposite direction. Price action is something that is very, very, very important. People claim to understand it, but not fully. Now, these are things that you need to reason out. Reason out, sit down and look at the market. If you want to make money with trading, you have to sit down and study the market like how people who make money study the market. Trading is not what it seems. It's more than just looking at a support and resistance. It's understanding what's happening behind the scenes and putting logic to it. Like this. So with that said, guys, peace.